What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we are doing some stock analysis for Mercado Libre, and this is an e-commerce company that primarily operates in Latin America. We're looking at a company of about 99, almost $100 billion market cap, and in the last year, this stock is up roughly 33%. So we're going to do some analysis to see how's the valuation and is this a quality company or not. So first thing I want to look at is let's look at how about we look at revenue. If we go to their revenue chart, we can see that this company's had pretty nice and consistent growth. Let's go to Mercado Libre annual revenue. Trailing 12 months, they've done $18 billion in revenue, $5.5 billion in free cash flow, and $1.4 billion in net income. Then, if we look at it on an annual basis to compare year over year, in the last 5 years, they've averaged 58% revenue growth. That's insane. That's crazy. 14 billion last year. And look how consistent it is. Almost every year it jumps up. Free cash flow, little bit different. Just in the last couple of years, we've seen really big jumps in free cash flow and with net income because it was negative for a couple of years here. And then in 2021, it turned positive, and now their profits are over $1 billion. Okay. If we look at their balance sheet, look at the cash position. Over $7 billion in cash and nearly $2 billion in debt. That's a strong ratio. That looks good. ROI of 28%. That's solid. I like that. And now if we look at what analysts have them doing, we're looking at $34 of EPS expected this year and then 47 next year. So this company is growing very fast. They did 19 in EPS last year. And so if we're looking on a PE basis of, let's say for this year, you are paying 57 times earnings right now. And here's the P ratio for the last couple of years. You can see it pretty much has, since it's come down to about 65, it kind of stalls out, kind of hangs out around this range. So 57 is actually kind of cheap, right? Because normally the stock is at, it looks like it rarely trades anywhere near 57. Then on a forward basis, we are looking at paying 42 times earnings, which is actually pretty cheap considering how fast they're growing. So it's got a lot of attractive traits about it. If we want to see, I mean, realistically, if this stock has been trading around 60, 65 times up to 80, I mean, you could almost put a 70 times earnings on this, which is that is expensive though. We have been in a very big bull market too this last year and a half. And that's where I think the premium could definitely come down. But if for some reason it were to keep trading in this range, that means this stock should be about $3,300 by the end of next year. That's if things stay this way, which I really don't think they are. I really think we're having a correction in the next couple months. We got to have some sort of little bear market or something, just something to correct us. Not like not as bad as 2022, but something that just brings these stocks back to reasonable valuations. So let's say it even trades at 55 times earnings. Well, now the stock's still $2,600. So really, I mean, this stock is not overvalued, really. It's really not overvalued because you're paying $100 billion. But I mean, if they're doing, look at that, 20 billion. They're growing revenue 42% this year and then 22% next year. 20 billion, then 25 billion in revenue. So if you're paying $100 billion and they're jumping up revenue numbers that fast, that's not a lot. So I mean, I would consider buying this. I just feel like since that's not really a US company, it's just harder to gauge exactly what the sentiment is like with this stock, what the interest is, how, what I don't know a lot about their platform and stuff, so it's hard to tell. But the numbers are what's important, and all the numbers look good, right? What's their margin? We're looking at a profit margin of only 6% for this past quarter, but they just turned profitable 3 years ago. So those numbers should go up. And you're also getting, I mean, 7 billion in cash. It's really, I mean, it sounds like 60, 70 times earnings is a lot, but I don't know. I mean, they're growing quick and they're growing into that valuation pretty quickly. If they keep up giant 20% growth. Like, what has net income been doing? Net income the last 5 years, they don't have a 5 year growth, but it looks like it's roughly 30%. I mean, these numbers are kind of outrageous. 83 million, 480, and then $1 billion. Those are kind of outrageous, but I don't know. I don't really have anything bad to say. I don't have anything bad to say. All I can say is that you're sort of playing with fire anytime you're buying stocks for over 60 times earnings, because there's always a chance that growth slows. And as soon as that growth comes down to, let's say, 5% or 8% or something instead of 30%, then that multiple is going to get crushed. That multiple is going to come down to 25 or maybe 35 times earnings, not 65 and 75. That's where the stock can get cut in half. Is that likely with this stock? I don't know about that. I don't want to say that. But I don't know. This stock could keep going. How I said, this could be, I could see this being 2,500 or 2,700 next year. So it's something to watch. It's interesting. But again, I'm not going to be super quick to jump on this and invest right now, but I will watch it though. It's interesting. Thank you very much for watching. I will see you in the next video.